The fundamental concept of monetary science. 39. The preceding considerations now enable us to perceive the fundamental concept of monetary science. We have seen that writers of all classes are agreed as to the fundamental nature of money. It represents debts which are due to persons who have done services to others and have received no equivalent services in return. It merely represents the right to demand these equivalent services when they please. And its special function is to measure, record, and preserve these rights for future use and to transfer these claims to anyone else. If all the services exchanged in society exactly balanced, there would be no need for money. Supposing then that there was nothing but metallic money in use, the following axiom is evident. The quantity of money in any country represents the quantity of debt that there would be if there were no money. But as we have seen that in civilized countries, these debts or rights are recorded in the simple form of rights against particular persons, as well as in metallic coin, which are rights against the general community. The term currency includes these debts or rights in both forms. Hence, it is clear that the currency represents nothing but transferable debt, and that whatever represents transferable debt is currency. Whatever its nature or form may be, either metal or paper or anything else. Consequently, this proposition necessarily follows. Where there is no debt, there can be no currency. All erroneous theories of currency have been founded on not perceiving the fundamental nature of currency, and the greatest monetary disasters the world has ever seen have been produced by violating this fundamental axiom. On the distinction between money and credit, number 40. It has now been shown that money and credit are essentially of the same nature, money being only the highest and most general form of credit. They are each a right or a title to demand something to be paid or done by someone else. No one can compel anyone else to sell him anything for money or credit. When, therefore, any person has voluntarily taken money in exchange for anything, it is in reality only credit, because he only takes it in the belief that he can exchange it away again. But suppose that a sale has taken place and that a debt has been incurred thereby. Public policy requires that the debtor should be able to compel the creditor to accept something in discharge of his debt. It would cause infinite misery if creditors could arbitrarily refuse the offer of payment of their debts. Hence, in all countries, the law declares that if a debt has been incurred, the debtor can compel the creditor to accept some specific thing in payment of it. Whatever that something is which a debtor can compel a creditor to accept in payment of a debt is termed money or legal tender. From this, it follows that some things may be money in some cases and not in others. Gold coin is money or legal tender in all cases and to any amount. Silver is only money to the amount of 40s. If a creditor chooses to accept it in payment to a larger amount than 40s, it is entirely of his own free will. In England, as between the public and the Bank of England, banknotes are nothing but credit. The bank cannot compel anyone to receive its notes, and any holder of its notes can compel the bank to cash them on demand. Between private persons, a banknote for £5 is not legal tender or money for that exact amount of debt. But in all debts above £5, banknotes are money or legal tender. But even this is only so long as the bank pays its notes in cash on demand. If the bank were to stop payment, its notes would cease to be legal tender in any case. In Scotland and Ireland, Bank of England notes are not legal tender in any case. If two persons are mutually indebted in equal amounts and payable at the same time, each may compel the other to accept the debt he owes in payment of the debt which is due to him. Each debt is therefore money or legal tender in respect to the other. This is a principle of supreme importance in modern commerce, as will be shown more fully hereafter. Reason why paper can supersede money. 41. The reason why paper can supersede money is now apparent. An order to receive a coat could never serve as a substitute for a coat because it cannot serve the same purpose as a coat. An order to receive bread or wine cannot supersede bread or wine because it cannot serve the same purpose as bread or wine, and so on, regarding orders for other material chattels. An order for such things can never serve as a substitute for the things themselves because they are heterogeneous quantities and cannot serve the same purpose as the things themselves. But an order to pay money can serve as a substitute for money because they are homogeneous quantities. A piece of money is of no more direct use for eating, drinking, or clothing than a piece of paper. Consequently, the exchange of paper for money is nothing more than the exchange of a particular right for a general right. As Daniel Webster, the eminent American jurist, said, credit is to money what money is to goods. That is, credit is an order for money, and money is an order for goods. To be useful, money must be exchanged away, just as paper is. Hence, if paper can be exchanged for exactly the same things that gold can, paper has the same value as gold. As the Italians say, che oro vale ore. That which is of the value of gold is gold. The same quantity may require to be regarded in different aspects in different sciences. 42. It is very essential to observe that the same quantities may be common to two sciences and may require to be regarded in different aspects in each. Thus, jurisprudence and economics are inseparably allied, and money and banknotes, bills of exchange, and abstract rights are both juridical and economical quantities, but they differ in some respects accordingly as they are regarded in a juridical and in an economical aspect. Thus, in jurisprudence, money is the absolute payment and satisfaction for a debt and a closing of the transaction, and bills of exchange are not the closing of the transaction unless they are accepted as such. Also in jurisprudence, money is corporal property. Abstract rights and rights of action are incorporeal property. But if these rights and rights of action are recorded on a material such as paper, parchment, or any other, they become corporal or material property. But in economics, a payment in money is not the closing of the transaction. A complete exchange is the obtaining a satisfaction for a satisfaction. In economics, money is only an abstract right, preserved and recorded in gold to obtain a satisfaction. Money is therefore, in economics, a bill of exchange in gold. So in economics, rights, whether purely abstract or recorded on paper, are absolutely the same. A piece of money is no more an economic satisfaction than a piece of paper. Hence, in economics, money and rights of action, whether abstract or recorded on paper, are all of the same nature. They are all simply rights to demand something in future. Hence, in economics, they are all equally incorporeal property or credit. But as they all equally possess the quality of exchangeability, they are all wealth. There is no more necessary relation between the quantity of money in any country and the quantity of commodities or their price. 43. We have now to demonstrate a proposition of the greatest importance in economics, and on which errors of the most serious nature are very prevalent. Many writers on economics have supposed that the quantity of money in a country bears some necessary relation to the quantity of commodities in it, and many more think that the prices of commodities are determined by the ratio which the quantity of metallic money bears to the quantity of commodities. That this is a very grievous error may very easily be shown. Suppose that A and B are mutually indebted, that A owes B 10 pounds and B owes A £13. Then it is quite clear that their debts may be settled in three different ways. 1. Each may send a check to demand payment of his debt in money. This method would require £23 to discharge the two debts. 2. A may send £10 to B to discharge his debt, and B may send back to A the same £10 with an additional £3 to discharge his debt. This method would require £13 to discharge the two debts. 3. They may meet and set off their mutual debts and pay only the difference in coin. By this means, the two debts would be discharged by the use only of £3. Now, it is quite clear that a very different quantity of money would be required to carry on any given amount of business, according as either of these methods of settling debts was adopted. Between the first and the third methods, there is a difference of £20, but there would be no difference in the price of commodities. These £20 would not influence prices, but would only be required to settle debts in a clumsy way, so that it is clear that by a simple change in the method of doing business, £20 may be withdrawn from its employment and applied to new transactions. From these considerations, it appears there may be large quantities of money in a country which may exercise no influence on prices, and the ratio between money and commodities may vary greatly according as one or other of these methods of doing business is adopted. Now, if a country which habitually used the first method were to change its custom and adopt the third method, it is very clear that a very large quantity of money might be disengaged from its usual employment and applied to promote new operations. And therefore, for all practical purposes, it would be an addition to the previously existing quantity of money. Hence, the various methods of economizing the use of money are to be considered as an increase of the resources of the nation. It is one of the great functions of a bank to promote such a change in the method of doing business and to bring people together to balance their mutual debts without the intervention of money. And it will be shown in subsequent chapters how immensely the skillful development of the method of modern banking economies and of modern banking economizes and develops the national resources. On barter, sale or circulation and exchange on barter. 44. When material products are exchanged directly for products, the transaction is termed barter. On sale or circulation, the economists only admitted an exchange to be where a product was exchanged for a product, i.e. a barter. That is where each side obtained a satisfaction. But in modern times, such exchanges are comparatively rare. Persons usually want to obtain things from others, while those others want nothing from them. To obviate the inconvenience that would arise if no one could get what he wanted unless he could supply the other party at the same time with what he wanted, people hit upon the plan of adopting some particular commodity which would be universally exchangeable. The buyer, therefore, gave the seller in exchange for his product an equivalent of this universally exchangeable merchandise, so that he could get any satisfaction he pleased from anyone else who could render it. This universally exchangeable merchandise is termed money, and the exchange of a product for money is termed a sale. The person who has got the money has not got a satisfaction. His desire is not consummated or completed. In order to obtain a satisfaction, he must exchange away the money for some product he does desire. Hence, the economist termed a sale a demi-exchange. Les Trosny says, there is this difference between an exchange and a sale, that in an exchange, everything is consummated or completed, consommé, for each party. They possess a thing which they desire to procure, and they have only to enjoy it. In the sale, on the contrary, it is only the purchaser who has obtained his object, because it is only he who is in a position to enjoy. But everything is not ended for the seller. And again, exchange arrives directly at its object, which is completion. consummation. It has only two terms and is ended in one contract, but a contract in which money intervenes is not completed, consommé. But it is necessary that the seller should become a buyer, either himself or by the interposition of the person to whom he transfers the money. There are therefore, in order to arrive at completion, consummation, which is the ultimate object, at least four terms and three contractants, of whom one intervenes twice. When, however, the person who had sold his product for money and therefore furnished the satisfaction to the other party had himself exchanged away the money and obtained a product for it, he too had acquired a satisfaction which he could enjoy, and the exchange was completed, consommé. For this reason, money was called the medium of exchange. This sale the economists called circulation. Sale or circulation, therefore, the economists defined to mean the exchange of a product for money. Both credit is used in all respects in the same way as money to purchase or circulate commodities. Hence, sale or circulation always denotes an exchange in which one or both of the quantities exchanged is money or credit. The sum total of these sales is properly termed the circulation. Hence, any sum of money may add considerably to the circulation, because every time it is transferred, it is a sale, and therefore it augments the circulation. As the use of money and credit is to set industry in motion, and is so much as they have no use unless they do that, their beneficial effects are not to be measured by their actual amount, but in the industry which they generate. Money lying locked up in a box or credit unused only represents latent power and not actual power. They may be called power or wealth in the Latin latent state. They resemble the steam engine of a mill, which is not going, and which is of no use until it is set in motion. And as the produce of the mill is measured by the quantity of the motion of the engine, so the useful effect of money and credit is measured by their quantity of motion, which is called the circulation. The circulation, which is the sole test of their useful effect, is, therefore, the product of their amount multiplied into the velocity of their circulation. The quantity of motion of the engine is called its duty. Hence, the circulation of money and credit may be termed its duty. It is so essential to have a clear conception of the useful effect produced by any amount of money and credit, that they may add another illustration. The effect produced by any body in motion is measured by its weight or mass multiplied into its velocity, which is termed its momentum. If the mass be diminished, yet by increasing the velocity, the effect or momentum may still be the same. If a body weighing 100 pounds moves with a velocity 1, its momentum may be 100. But if we diminish the weight to 50 pounds and can double its velocity, the effect or momentum will still be the same. The effects of money or credit are exactly analogous. Their useful effect is the result of their combined amount and velocity of circulation, which is termed the circulation. If we can make 50 pounds circulate with twice the velocity of 100 pounds, the useful effect or circulation will be the same. Hence, it may be said that the circulation is the momentum of money and credit. On exchange. An exchange is the interchange of things of a like nature, either products for products, or money or credit for money or credit, or money or credit, or money or credit for money or credit. Thus, we speak of the foreign exchanges, or the value of the money of one country in terms of the money of another. Or we ask for the change, i.e. the change or exchange of a £5 note or a sovereign A bill of exchange is a right of action to be exchanged at the proper time for money. So we exchange one book for another or a picture for a statue. So in Lear, when Albany throws down his glove to the trader Edmund, the latter, throwing down his own, says, "There's my exchange." And a little further on, Edgar says to Edmund, "Let's exchange charity." So in Hamlet, Laertes says, "Exchange forgiveness with me, noble Hamlet." When the interchange is between products and money or credit, the one who gives the money or credit is said to buy the product, and the one who gives the product is said to sell it. When the exchange is between money or credit for money or credit, each side is said to buy and to sell, and each quantity of money or credit exchanged for the other is termed the price of the other. Thus, we buy a horse or a house or land or cattle or a bill of exchange with money or credit. An officer formerly bought a commission in the army, but he exchanged from one regiment into another. On the meaning of circulating medium, 45. We have now to consider two terms, circulating medium and currency, which are both of comparatively modern origin, which have in recent times given rise to many controversies, but which are admitted to be synonymous. And consequently, if we can positively determine the meaning of one of them, that will also necessarily determine the meaning of the other. The term circulating medium seems to have come into use in the last decade of the last century. It does not occur in Adam Smith. The first occasion on which we have met it is in the debate on the Bank Restriction Act of 1797, in which Fox said he wished that gentlemen, instead of amusing themselves with new terms of circulating medium and the like, etc., which shows that it must then have been of very recent origin. Pitt, in his reply, said, as so much had been said on the nature of a circulating medium, he thought it necessary to notice that he did not, for his own part, take it to be of that empirical kind which had been generally described. It appeared to him to consist in anything that answered the great purposes of trade and commerce, whether in species, paper, or any other term which might be used. It is quite evident, therefore, that Pitt included under the term circulating medium money and credit in all its forms. The verb to circulate, like many others in English, has both an active and a neutral or neuter meaning. Number one, it means that which circulates commodities, i.e., which causes products to circulate, where it is an active verb. Two, that which circulates itself, where it is a neuter verb. Smith uses the word circulate in both senses in different places. Thus, speaking of gold and silver, he says their use consists in circulating commodities. The great wheel of circulation is altogether different from the goods circulated by it. The revenue of the society consists altogether in these goods and not in the wheel that circulates them. Where circulates is active. On the meaning of currency, 46. The meaning of the word currency, which all writers admit to be synonymous with circulating medium, has given rise to protracted controversies in modern times, which, however, we shall not notice as at present. We shall in this section explain the true meaning of the word. The word currency is in fact a technical term in mercantile and constitutional law, and the following is the true meaning of current and currency in English law. It is a general rule of law that a person cannot transmit to another any better title to a thing than he has himself. It is also a general rule of law that if a person loses a thing or has it stolen from him, he does not lose the property in it. Consequently, he cannot only recover it from the thief or finder, but also from anyone else in whose possession he may find it, even though that person may have bought it or taken it in pledge and given full value for it, and not knowing that it was not the lawful property of the seller or pledger. This right of recovery is called jus vindicandi in Roman law. But to this rule of law, money was always, from the necessity of the case, an exception. If the true owner of the money finds it in the possession of the thief or finder, he can reclaim it. But if the thief or finder has once purchased goods in a shop with it, and the shopkeeper takes it honestly in the way of business and without knowing that it has been stolen, he can retain it against the true owner, even though he should be able to identify it. That is, the person who acquires money honestly in business has a good title to it, even though the transferor had not. Thus, it is said in law that the property in money passes by delivery. Thus, after the money has once been passed away in commerce to an innocent receiver, the true owner has lost his jus vindicandi. Vindicandi. It is this peculiarity which affects the property in money which passes by delivery, which is denoted by the words current and currency in English law. And when an act of Parliament declares that any instrument shall be current, it means that the property in it shall pass by delivery to the innocent purchaser. This attribute of currency is also termed negotiability. And when the representatives of money, such as banknotes, checks, bills of exchange, etc., came into use, the law merchant applied the same principle of currency to them. They are like money insofar as this, that the property in them passes like the property in money. Thus, if they are not lost or stolen, the true owner may recover them if he can find them in the hands of the thief or finder. But if the finder or thief manages to pass them away for value in the ordinary course of business to an innocent purchaser, that innocent purchaser acquires the property in them and may retain them against the true owner and enforce payment of them from all parties liable. This doctrine has been affirmed in a whole series of cases in the courts, which we shall notice shortly. It follows from this that in strict law, this principle of currency can only be applied to those rights of action which are recorded on some material. An abstract right cannot be lost, mislaid, or stolen, or passed away in commerce. For a right to be currency in strict law, it must be recorded on some material, so as to be capable of being carried in the hand, or in the pocket, or put away in a drawer, or dropped in the street, or stolen from the drawer or the pocket, or carried off by the finder or thief, and transferred in commerce. So far then, as regards mercantile law, there is no difficulty. The meaning of the word is perfectly clear. But if the word currency is used to denote a certain class of economic quantities synonymous with circulating medium, a difficulty arises because there is an immense mass of credit which has produced exchanges and has circulated commodities and is therefore circulating medium, which is not recorded on any material at all in such a way that it can be lost or stolen and carried off and transferred in commerce by manual delivery. Thus, the gigantic mass of banking credits and the book debts of traders have all affected a sale or circulation, and therefore they are all circulating medium. But they have not the attribute of currency in a legal sense, because they cannot be mislaid, lost, or stolen, and picked up and passed away in commerce by manual delivery. So also private debts between persons termed verbal credits. They only arise out of the transfer of goods or money, and they exist equally whether they are recorded on paper or not. They are equally circulating medium. Private debts among traders affect prices exactly like so much money. Consequently, though, they are not currency in strict law. Yet if that word is still to be retained in a scientific sense as denoting a certain class of economic quantities, synonymous with circulating medium, they must all be included under that term, because they can all be recorded on paper at pleasure. And their nature and effects are exactly the same, whether they are recorded on paper or not. In the great discussions in Parliament, which arose out of the suspension of cash payments by the Bank of England, no attempt was made to define the term currency, but all the speakers assumed that it comprehended money or credit in all its forms. This truth was well expressed by Lord Titchfield in the House of Commons. Speaking of the various forms of credit used as substitutes for money, he said, when it was considered to how great an extent these contrivances had been practiced in the various modes of verbal, book, and circulating credits, it was easy to see that the country had received a great addition to its currency. This addition to the currency would have the same effect as if gold had been increased from the mines. Decisions of the courts of law regarding the meaning of currency. The meaning of the word currency has acquired so much practical importance in consequence of the Bank Charter Act of 1844, being based on a peculiar definition of it, which will have to be examined hereafter, that it will be more satisfactory to our readers to place before them a resume of the decisions of the courts of law as to the meaning of the term. Banknotes. In Miller versus Race, 1 Burr. 452, confirming anonymous 1 Lord Raymond, 738, the Court of Queen's Bench decided that banknotes have the credit and currency of money to all intents and purposes. An action would lie against the finder that no one disputes, but not after the note had been paid away in currency. An action would not lie against the defendant because he took it in the course of currency, and therefore it could not be followed into his hands. It never shall be followed into the hands of a person who bona fide took it in the course of currency. A banknote is constantly and universally, both at home and abroad, treated as money, as cash, and it is necessary for the purpose of commerce that their currency should be established and maintained. Checks. In Grant versus Vaughan, 3 Burr, 1516, the court unanimously held that checks possess the attribute of currency, exactly like banknotes, bills of exchange. In Peacock versus Rhodes, 2nd Douglas, 633, the court decided that bills of exchange possess the attribute of currency, exactly the same as banknotes. Lord Mansfield said, the holder of a bill of exchange or promissory note is not to be considered in the light of an assignee of the payee. An assignee must take the thing assigned subject to all the equity to which the original party was subject. If this rule applied to bills and promissory notes, it would stop their currency. The law is settled that a holder coming fairly by a note or bill has nothing to do with the transaction between the original parties. I see no difference between a note endorsed blank and one payable to bearer. They both go by delivery, and possession proves property in both cases. In Collins versus Martin, B and P for 648, the same doctrine of currency was applied to pledging bills equally as to selling them. Here, CJ said, for the purpose of rendering bills of exchange negotiable, the right of property in them passes with the bills. Every holder with the bills takes the property and his title is stamped upon the bills themselves. The property and the possession are inseparable. This was necessary to make them negotiable. In this respect, they differ essentially from goods, of which the property and the possession are in different persons. Foreign bonds. In Gorger versus Myville, 3 B and C, foreign bonds payable to the holder were decided to possess the attribute of currency, exactly as banknotes and bills endorsed in blank. Exchequer bills. In Woke versus Pohl, 4B and Ald, 1, exchequer bills payable to blank or order were also decided to possess the attribute of currency. The question was whether exchequer bills followed the law of goods, in which there is the jus vindicandi, or the law of money, in which there is no jus vindicandi. The court decided that exchequer bills follow the law of money. Holroyd J. said, it has long been fully settled that banknotes or bills Drafts on bankers, bills of exchange, and promissory notes, either payable to order or endorsed in blank, or payable to bearer when taken bona fide, and for a valuable consideration passed by delivery, and vest a right thereto in the transferee, without regard to the title or want of title in the person transferring them. These authorities show that not only money itself may pass and the right to it may arise by currency alone, but further that these mercantile instruments, which entitle the bearer of them to money, may also pass, and the right to them arise in the like manner by currency or delivery. We next consider the nature and effect of the instrument, both as to the property which it concerns and as to its negotiability or currency by law. The instrument is created by the Statute 48, Geo 3, Chapter 1 or Column 1, and is hereby made negotiable and current. The case therefore stands thus: this exchequer bill was a current and negotiable instrument. For the payment of money, some money passes from one person to another by reason of its currency, and for that reason only, and not because it has no earmark. It cannot be recovered from the person to whom it had been passed. The exchequer bill, therefore, seems to me, upon the same principle, to follow the nature of the money for which it is a security. In Ingham versus Primrose, Williams J. says it is, we think, settled law that if the defendant had drawn a check, and if before he had issued it, he had lost it, or it had been stolen from him, and it had afterwards found its way into the hands of a holder for value without notice, who had sued the defendant upon it, he would have had no answer to the action. So if he had endorsed a bill in blank, or a bill payable to his order, or if it had been lost or stolen before he had delivered it to any one as endorsee. The reason is that such negotiable instruments have, by the law merchant, become part of the mercantile currency of the country. And in order that this may not be impeded, it is requisite that innocent holders for value should have a right to enforce payment of them against those who, by making them, have caused them to be part of such currency. In Whistler versus Forster, Wiles J. said, the general rule of law is undoubted that no one can transfer a better title than he himself possesses. To this, there are some exceptions, one of which arises out of the rule of the law merchant as to negotiable instruments. These, being part of the currency, are subject to the same rule as money. In Chute versus Robbins, Lord Tenterden spoke of banker's paper as being part of the circulating medium of the country. In Lang versus Smith, Tyndall C.J. said, the first question was whether the instruments in dispute had acquired, from the course of dealing pursued in the city, the character of banknotes, bills of exchange, dividend warrants, and checks, bills, or other instruments which form part of the currency of the country. In Goodwin versus Robarus, Serap entitling the bearer to demand bonds from a foreign government were also decided to possess the attribute of currency. These extracts authoritatively decide the true meaning of the word currency. It means that the property to which the attribute is attached is an exception to the general jus vindicandi, which attaches to goods. It means that when once this class of property has been acquired honestly in business by a purchaser, the property in it passes by delivery. And this is the sole meaning of the word currency. Those cases also decide that money and all written securities for money made transferable by the parties to them are all included under the term currency. The different forms of currency, 48. Adopting then the terms currency and circulating medium as absolutely identical and synonymous, and designating a certain class of economic quantities is different forms. Its different forms are 1. Coined money, gold, silver, and copper. 2. The paper currency, banknotes, checks, bills of exchange, exchequer bills, etc. 3, simple debts of all sorts, not recorded as circulating paper, such as credits in bankers' books, termed deposits, book debts of traders, and private debts between persons, because all these debts may be recorded on paper at the will of the parties, which in no way alters their nature. All these denote that a transaction has taken place and are titles to future payment. From these considerations, it follows that the currency or circulating medium of any country is the sum total of all the debts due to every individual in it. That is all the money and credit in it. Postage stamps must also be included under the term currency. They are a most usual form of remittance. They pass in small payments, and since the post office is bound to cash them, they are in fact penny notes. Though the point has been decided at law, there can be no doubt that if anyone were to steal postage stamps, it would be taken honestly in payment. It would be held that they possess the attribute of currency, hence they are strictly currency. On the channel of circulation, 49. The quantity of the circulation or the amount of money and credit representing the indebtedness or the balances which arise from the unequal exchanges of products and services is frequently termed by Adam Smith and other writers the channel of circulation. This channel of circulation is filled with some material, and prices are estimated by the quantity of this material, which is given in exchange for any economic quantities. Let us suppose that gold alone was used at any time to represent debt and fill the channel of circulation. This gold, metal, is divided into certain pieces of fixed weight and quality, termed coins, and prices are estimated in those coins. But suppose that at any time gold was discontinued and silver substituted as a representative of debt. And suppose that coins were struck of silver of exactly the same weight as the gold ones. Then, as silver is at present about 18 times less valuable as gold, it would require 18 times as many silver coins to represent any amount of debt as it would gold coins. And prices would rise 18-fold, but other products would still preserve the same relations among themselves. Hence, though prices would rise, yet the values of products would, with respect to each other, would remain exactly the same. Again, suppose that silver was taken away as the representative of debt and copper substituted, and copper coins struck of the same weight as the previous gold and silver ones and called by the same name. Then prices would be estimated in copper coins. And as copper is about 900 times less valuable than gold, prices estimated in copper would rise to about 900 times their amount in gold. But the relative values of all other quantities would remain the same. Now, as the value of gold as representing debt depends upon the quantity of gold which represents any amount of debt, it would manifestly follow that if the quantity of gold which represented any amount of debt were greatly increased, the value of gold would greatly diminish. If gold became as plentiful as silver, gold would have no more value than silver. Consequently, even while the weight and the quality of the coins remained the same, gold would fall to the 18th part of its former value as a purchasing power. So if gold became as plentiful as copper, it would be of no more purchasing power than copper. That is, it would fall to about the 900th part of its former value. Thus, in a general way, if any quantity of stuff of any sort is used to represent any quantity of debt at any time, and if the quantity of stuff is greatly increased, while the quantity of debt remains the same, it necessarily produces a great diminution in the value of the stuff and a general rise of prices. But the quantity of stuff which represents debt and fills the channel of circulation need not be all of the same material. It may be partly gold, partly silver, and partly copper, and prices will be estimated by the whole quantity of stuff which fills the channel of circulation, and not by any particular portion of it. In modern times, a new kind of stuff is employed to a gigantic extent to fill the channel of circulation, and that is credit, or rights of action in various forms. With respect to credit, there is a most important observation to be made. Credits in some countries are made payable in gold, and in some countries in silver. Now, credits payable in gold are exactly of the same value as gold, and credits payable in silver are of exactly the same value as silver. Hence, the value of gold throughout the world is determined not only by the actual quantity of gold, but by the aggregate quantity of gold and all credits payable in gold. So the value of silver throughout the world is determined not only by the actual quantity of silver itself, but by the aggregate quantity of silver and all credits payable in silver. And furthermore, the value of gold with respect to silver is determined not only by the relative quantities of gold and silver themselves, but by the ratio of gold and all credits payable in gold compared to the aggregate of silver and all credits payable in silver. It is the enormous creation of credit in modern times in the form of banking credits and mercantile credits, which has so prodigiously raised the prices of products and diminished the rate of interest in the last 2 centuries in this and many other countries, as we shall show more fully hereafter. It will be shown hereafter that the quantity of credit which is used and is in circulation in this country is at least 50 times the amount of metallic coin. Furthermore, there are in some countries, like Russia, vast quantities of incontrovertible paper money, which are at a heavy discount as compared with specie, but at the same time of their value in specie. Hence the thorough comprehension of the principles and mechanism of the colossal system of credit is the very foundation of modern economics. It is the quantity of credit in modern times which chiefly determines the price of products, and variations in the quantity of credit produce more changes in the value of products than any variations in the quantity of gold and silver. And it is the abuses of credit which produce these terrible calamities termed commercial crises and monetary panics, which we shall have to investigate here afterwards. On price, 50. When any economic quantity is exchanged for any other economic quantity, each is termed the value of the other. But when one or both of the quantities exchanged as money or credit, it receives a special name. It is termed price. Price, therefore, is always value expressed in money or credit. Now, the value of money is any other economic quantity which can be obtained in exchange for it, either a material chattel or a service or a right, such as a debt. If money be taken as the fixed quantity, the more of the other quantity which can be obtained for it, the greater is the value of money. The less of the other quantity which can be obtained for it, the less is the value of money. Or if the other quantity be taken as the fixed quantity, the less the money given for it, the greater is the value of money. The more the money given for the fixed quantity, the less is the value of money. Hence, it is seen that the value of money varies inversely as price, but credits or debts are commodities or merchandise, which are brought into commerce and bought and sold or exchanged like any other merchandise. Now, when any commodities or merchandise are brought into commerce, they are always divided into certain units for the convenience of sale. Coals are sold by the ton, corn by the quarter, tea and sugar by the pound, cloth by the yard, wine and other liquids by the quart or the pint, etc. So for the convenience of commerce, bullion is divided into certain units called coins. In a similar way, when the commodity or merchandise termed credit or debt is brought into commerce, it must, for the convenience of sale, be divided into units. The unit of credit or debt is the right to demand £100 to be paid 1 year hence. The sum of money given to purchase the unit of debt is also termed its price. And as in all other sales, the less the quantity of money given for any fixed amount of debt, the greater is the value of money. And the greater the quantity of money given to purchase any fixed amount of debt, the less is the value of money. And the less the amount of debt a fixed quantity of money will purchase, the less is the value of money. And the greater the amount of debt a fixed quantity of money will purchase. The greater is the value of money. Hence, the value of money with respect to debts varies exactly in the same way as it does with respect to other merchandise. But in the commerce of debts, it is not unusual. It is not usual to estimate the value of money by the quantity of debt it will purchase. As money naturally produces a profit, it is clear that the value or price of a debt to be paid only 1 year hence must be less than the actual amount of the debt. The difference between the present value or the price of the debt and the amount of the debt is the profit made by buying it. This difference or profit is termed discount. In the commerce of debts, it is universally the custom to estimate the value of money by the discount or profit it yields, and not by the price of the debt. Now, as the price of the debt decreases or increases, it is evident that the discount increases or decreases, and the value of money measured in this way increases or decreases. Hence, in the commerce of debts, the value of money varies directly as the discount. This rule embraces both branches of commerce. The value of money carries inversely at its price. The value of money varies inversely as price and directly as discount. To discount a debt is to pay down the present value of its amount payable at a future time. Hence, it must be observed that the term value of money has two distinct meanings in commerce. There are three great branches of commerce: the commerce in material commodities, the commerce in services, and the commerce in debts. And the expression value of money has two distinct meanings according as it is applied to these three branches of commerce. In the commerce of material commodities or of services, it means the quantity of the commodity or service which money can purchase. In the commerce of debts, it means the discount or profit made by buying the debt.